Options are financial contracts that grant buyers the right, but not the obligation, to buy or sell a specified underlying asset at a predetermined price on or before a specified date. A call option is a contract that grants the owner the right, but not the obligation, to buy the underlying asset by a specified date and at a specified price. When this right is exercised, the option seller is then obliged to sell the underlying product under specified conditions to the option buyer. For example, if you're bullish on the market, you might consider buying a Nifty index call option. However, it's essential to analyze and determine which strike to buy. On the other hand, a put option is a contract that provides the owner the right, but not the obligation, to sell the underlying asset by a specified date and at a specified price. When this right is exercised, the option seller has the obligation to sell the underlying product to the option buyer under specified conditions. For instance, if you're bearish on the market, you might consider buying a Nifty index put option. Similarly, it's crucial to analyze and decide on the appropriate strike to buy. Now, let's delve into a practical example. Imagine deciding to buy Nifty 19,900 strike call expiring on September 29th at a premium of Rs 97.15. This reflects a bullish view on the market. To execute this trade, you'd pay a premium of Rs 4,857.50. In case 1, if Nifty trades higher, let's say at 20,000, and your view is correct, the option premium changes based on options Greeks, resulting in a profit. The Nifty 19,900 call option value increases from Rs 97.15 to Rs 137.15. Your profit would be Rs 40 by 50, totaling Rs 2,000. In case 2, if Nifty trades lower, for instance, at 19,800, and your view is incorrect, the option premium changes based on options Greeks, leading to a loss. The Nifty 19,900 call option value decreases from Rs 97.15 to Rs 67.15. Your loss would be Rs 30 by 50, totaling Rs 1,500. When it comes to call options, long buy, the maximum reward is infinite, while the maximum risk is the premium paid for the strike. The break-even point is calculated by adding the strike price and the premium. Short sell, here the maximum reward is the premium received by selling, and the maximum risk is infinite. For put options, long buy, the maximum reward is the difference between the strike price and the premium paid, and the maximum risk is the premium paid for the strike. The break-even point is calculated by subtracting the premium from the strike price. Short sell, in this case, the maximum reward is the premium received, and the maximum risk is the difference between the strike price and the premium. These principles are crucial in understanding the potential outcomes and risks associated with different option strategies. Understanding option moneyness is crucial in options trading. Let's break down the concepts for both call and put options. For call options, in money, this occurs when the market price of the underlying asset is more than your strike price. At money, here, the market price of the underlying asset is the same as your strike price. Out of the money, this happens when the market price of the underlying asset is less than your strike price. Now, let's explore put options. In money, this situation arises when the market price of the underlying asset is less than your strike price. At money, similar to call options, this is when the market price is the same as your strike price. Out of the money, this occurs when the market price of the underlying asset is more than your strike price. These distinctions play a vital role in determining the potential profitability and risk associated with different option strategies. Let's explore options Greeks, starting with delta. The options delta is essentially the rate of change of the options price concerning its underlying security's price. For calls, delta ranges from 0 to 1. It reflects how much the option price increases or decreases in response to a 1-point movement in the underlying asset's price. Options that are far out of the money tend to have delta values close to 0, while deep in the money options have deltas close to 1. Now, let's consider the passage of time and its effects on delta. As the time remaining to expiration diminishes, the time value of the option decreases. Consequently, the delta of in-the-money options tends to increase, while the delta of out-of-the-money options decreases. For example, if the delta is 0.6, it means that for a 1-point positive move in the underlying value, the call option will move by 0.6 points. Understanding delta is crucial for assessing how an option's price may change in response to market movements and the passage of time. Now, let's delve into another options Greek, gamma. The options gamma measures the rate of change of its delta. Expressed as a percentage, gamma reflects the change in delta in response to a 1-point movement in the underlying stock price. Similar to delta, gamma is dynamic and changes continually, even with small movements in the underlying stock price. It tends to be at its peak value when the stock price is near the strike price of the option, and decreases as the option goes deeper into or out of the money. Options that are very deep into or out of the money have gamma values close to 0. For example, let's consider sale, currently trading at 47. There's a November 50 call option selling for 2 with a delta of 0.4 and a gamma of 0.1. If the stock price moves up by 1 to 48, the delta will be adjusted upwards by 10% from 0.4 to 0.5. Conversely, if the stock trades downwards by 1 to 46, the delta will decrease by 10% to 0.3. Understanding gamma is crucial for gauging how the sensitivity of an option's delta changes in response to stock price movements. Now, let's explore another key options Greek, theta. Theta is a measure of an option's time decay, indicating how fast options lose their value, specifically the time value, as the expiration date approaches. Generally expressed as a negative number, theta reflects the daily amount by which the option's value will decrease. For instance, imagine a call option with a current price of 2 and a theta of minus 0.05. This means the option's price will drop by 0.05 per day. So, in 2 days' time, the option's price should fall to 1.90. Now, let's consider the passage of time and its effect on theta. Longer-term options have a theta of almost 0 as they do not lose value on a daily basis. Theta is higher for shorter-term options, especially at the money options. This is evident as these options have the highest time value, and thus, more premium to lose each day. Theta increases dramatically as options near expiration since time decay is at its greatest during that period. Additionally, changes in volatility impact theta. In general, options of high volatility stocks have higher theta than low volatility stocks. This is because the time value premium on these options is higher, leading to more to lose per day. Understanding theta is crucial for managing the impact of time decay on option prices. Let's dive into the concepts of intrinsic value and time value in options trading. Firstly, Intrinsic value is determined by the difference between the strike price and the current market price. It's important to note that intrinsic value is always present in in-the-money options, whereas out-of-the-money options have zero intrinsic value. Now, when it comes to calculating the overall option value, option value equals intrinsic value plus time value. The time value premium in an option decreases at an accelerated rate as the option approaches maturity. This is a crucial aspect to consider as it influences the overall value of the option. Understanding the interplay between intrinsic value and time value is essential for evaluating the potential worth of an option and making informed trading decisions. Let's delve into how the type of option, whether it's in the money, at the money, or out of the money, affects time value and intrinsic value. For call options, in the money, time value decreases as the option gets deeper in the money, causing intrinsic value to increase. At the money, time value is at its maximum when an option is at the money, while intrinsic value is zero. Out of the money, time value decreases as the option gets cheaper out of the money, making intrinsic value become zero. Now, let's consider put options. In the money, similar to call options, time value decreases as the option gets deeper in the money, leading to an increase in intrinsic value. At the money, time value is at its maximum when an option is at the money, with intrinsic value being zero. Out of the money, as with call options, time value decreases as the option gets cheaper out of the money, resulting in intrinsic value becoming zero. Understanding these dynamics is essential for gauging the impact of the option's position on both time value and intrinsic value. Now, let's put our knowledge into practice and do the math with a real-world example. Harish invested in Nifty futures when the market was at 19,400 levels. Manish, on the other hand, opted for options and bought a call option at a premium of rupees 100, expressing his bullish view for a strike price of 19,400. Let's explore the scenario if the market falls by 100 points. Harish's loss, with a position in Nifty futures, the loss amounts to rupees 5,000. Futures trading is inherently riskier. Manish's loss, trading Nifty options with a delta of 0.65 means the equivalent movement for every 1 point in futures is 0.65 in options. Therefore, Manish's loss is rupees 3,250. This example illustrates how options trading, with the right strategy, can potentially limit losses compared to trading in futures, showcasing the risk management aspect of options trading. Understanding the practical implications of options trading is crucial for making informed investment decisions. Now, let's continue our analysis and explore the scenario if the market rises by 100 points. In futures trading, Harish gains 5,000 rupees on an invested margin of rupees 1,24,000. This represents a 4% return on his investment. In options trading, Manish gains rupees 3,250, which translates to a 65% return on his investment of rupees 5,000. Assuming a delta of 0.65, buying options not only minimizes risk, as shown in the previous scenario, but also maximizes returns in a rising market. It's important to note that options trading, when timed correctly, can provide significant returns while managing risk effectively. This example underscores the strategic nature of options trading and the importance of market timing for optimizing both risk and returns. Now, let's delve into volume and open interest analysis, key indicators for understanding market trends. When it comes to interpreting the relationship between price, volume, and open interest, different scenarios arise. 1. Rising price, rising volume, rising open interest. This indicates a strong market trend where the price is rising, accompanied by increasing volume and open interest. 2. Rising price, falling volume, falling open interest. This signals a weakening or potential reversal of the trend. Although the price is rising, declining volume and open interest suggest a weakening market sentiment. 3. Falling price, rising volume, rising open interest. This scenario suggests a weak trend or a potential reversal. Despite the falling price, rising volume and open interest may indicate a shift in market sentiment. For falling price, falling volume, falling open interest. This signals a strong trend in a downward direction. The falling price, coupled with decreasing volume and open interest, indicates a robust bearish sentiment. Understanding the interplay between price movements, volume, and open interest is crucial for making informed trading decisions. It helps identify the strength of a trend and potential reversal points in the market. Let's explore a basic options strategy known as a buying options to protect futures, also referred to as synthetics. Buying options to protect futures involves two primary scenarios. 1. Buying a put with a long futures position. This strategy is employed to protect against potential downside risk. By purchasing a put option, the investor gains the right to sell the underlying asset at a predetermined price, providing a form of insurance against adverse market movements. This is particularly useful during volatile times. 2. Buying a call with short futures position. Alternatively, an investor can buy a call option while holding a short futures position. This strategy helps protect against potential upside risk. By purchasing a call option, the investor gains the right to buy the underlying asset at a predetermined price, allowing them to manage risk during periods of market uncertainty. These strategies come into play when holding positions in futures, especially during volatile market conditions. Whether the market has rallied or corrected sharply, using puts and calls provides additional tools to refine exit points and manage risk effectively. Now, let's explore another basic option strategy known as covered option writing. Covered option writing involves two primary scenarios. 1. Selling call options and buying futures. In this strategy, an investor sells call options while simultaneously buying futures contracts. This approach allows the investor to take advantage of the high premium from selling the call options, providing income. The added protection of buying futures helps mitigate potential losses in case the market moves against the investor. This strategy is often employed in less volatile markets. 2. Selling put options and shorting futures. Alternatively, an investor can sell put options while simultaneously shorting futures contracts. Similar to the first scenario, this strategy allows the investor to capitalize on the premium received from selling put options. The short futures position acts as a hedge against potential downside risk, making it a less risky strategy, especially in a volatile market. While covered option writing can provide income through premium collection, it comes with a limitation. The maximum profit is capped at the premium received. This strategy is suitable for investors seeking a more conservative approach to options trading. Let's dive into the world of options trading with a strategy known as straddles. Straddles are unique option spreads that involve both puts and calls. In a straddle, an investor can either buy or sell puts and calls at the same strike price. Throughout the life of a straddle, it's highly probable that at least one of the options will be in the money at various points in time. Now, there are two perspectives to consider when it comes to straddles. 1. Buying a straddle. This approach allows you to define the maximum risk per trade. However, the challenge is that you need the market to overcome both premiums to make a profit. 2. Selling a straddle. On the flip side, selling a straddle is a strategy that places the odds in your favor but elevates the level of risk. If the market moves within a certain range, the seller makes a profit, otherwise, the risk increases. Straddles offer a dynamic way to navigate market volatility, providing opportunities for both buyers and sellers to capitalize on price movements. Understanding the advantages and disadvantages of each approach is essential for making informed decisions in the options market. Now, let's explore another intriguing option strategy called strangles. Similar to straddles, strangles are option spreads involving both puts and calls. However, there's a key distinction: the strangle involves different strike prices, making it less likely for both, or even one, of the strangle legs to be in the money at any given point in time. Now, let's break down strangles from both buying and selling perspectives. 1. Buying a strangle. As a buyer, you might choose different strike prices, typically on either side of the market price. This strategy, the advantage here is that your risk is limited, providing a defined maximum loss. 2. Selling a strangle. On the selling side, this strategy can be profitable quite often. Since out-of-the-money calls often expire worthless, especially if they don't completely overcome the premiums paid, the seller benefits. However, it's essential to recognize the increased risk associated with selling a strangle. Strangles offer a versatile approach to navigating market uncertainty, providing both buyers and sellers with unique opportunities. Understanding the dynamics of different strike prices is crucial for implementing strangles effectively. Now, let's venture into the realm of options trading with a strategy known as butterfly spreads. A butterfly spread is a unique combination of both a bull spread and a bear spread, creating a three-strike price scenario. For instance, you might consider buying a June 290 call, selling the 2nd of June 300 calls, and then buying a June 310 call. Let's explore the key aspects of butterfly spreads. The strategy involves three strike prices, providing a nuanced approach to market positioning. The risks associated with butterfly spreads are limited, offering a defined maximum loss. However, it's important to note that the profit potential generally may not justify the costs involved. Traders need to carefully assess whether the potential gains align with their expectations. Given the complexities and nuances of butterfly spreads, it's crucial to approach these strategies with caution. Understanding the potential payoff and costs involved is paramount before engaging in such trades. Butterfly spreads showcase the intricate nature of options trading, offering a balanced combination of risk and reward. As with any strategy, thorough comprehension and careful consideration are essential before implementation. Now, let's discuss some crucial trading rules when it comes to options trading, focusing on our winning options. 1. Avoid deep-in-the-money options. One key rule is to stay away from deep-in-the-money options. While the advantages of buying options lie in high leverage and limited risk, deep-in-the-money options can reduce your leverage and increase your risk. Additionally, these options are less affected by time decay, which is a significant disadvantage for option sellers. 2. Avoid deep out-of-the-money options. Another important rule is to steer clear of deep out-of-the-money options. The illusion is that these options offer substantial leverage, but in reality, they often provide more hope than profit potential. Engaging in deep out-of-the-money options can lead to overcommitment with little opportunity for substantial profits. Remember, successful options trading requires a balance of risk and reward. Adhering to these rules can help you make more informed decisions and navigate the complexities of the options market effectively. Let's delve into more winning options trading rules to enhance your strategies. 1. Focus on slightly out of the money, at the money, or slightly in the money options. When trading options, consider positions in options that are slightly out of the money, at the money, or slightly in the money. These options carry a reasonable chance of proving profitable when bought. When selling, you benefit from the maximum possible time decay. Additionally, these options are generally the most liquid, providing smoother market entry and exit. 2. Timing is crucial. Recognize that there's a time for all seasons in the options market. Before implementing any option strategy, it's vital to have a feel for the current market conditions. Deep out-of-the-money options may seem enticing, but in reality, they often lead to overcommitment with little profit potential. Understanding the market's nuances and adjusting your strategy accordingly is key to successful options trading. These rules emphasize the importance of strategic decision-making and adapting to market conditions. By focusing on options with reasonable profit potential and aligning your strategy with market dynamics, you increase your chances of success in the world of options trading. Now, let's explore some essential precautions to keep in mind while using options for trading. 1. Strict stop loss is crucial. It's imperative to always maintain a strict stop loss when trading options. Setting predefined levels for stopping losses helps protect your capital and manage risk effectively. 2. Avoid averaging a losing position. Never average a losing position. This practice can amplify losses and expose you to increased risk. Instead, consider re-evaluating your strategy and risk management approach. 3. Be mindful of time decay. As options near their expiry date, the value of the option diminishes due to time decay. Stay aware of this factor and plan your trades accordingly. 4. Understand limited losses in buying options. Recognize that losses are limited when buying options compared to selling options. This is a key consideration when deciding between different option strategies. 5. Preference for options closer to market price. When forming a view on options, it's advisable to prefer options closer to the market price. In-the-money options are often considered better than out-of-the-money options as they have a higher likelihood of proving profitable. By adhering to these precautions, you can navigate the options market more confidently, mitigating risks and optimizing your trading outcomes. Thank you for joining me in this video. I hope you found the information valuable and insightful. If you have any doubts or questions, feel free to reach out via WhatsApp at the number provided below. And hey, if you haven't subscribed to this channel yet, now's the perfect time. Don't miss out on future trading strategy videos and updates. Your subscription helps support the channel and ensures you stay updated with the latest insights. I'll be back soon with another exciting trading strategy video. Until then, take care and happy trading.